Today is January 9, 2026. To most observers, it is another trading day at the start of a new year. Yet beneath the surface, the silver market has crossed thresholds that ordinary headlines seldom capture. On this day, as prices quietly monitor near 78 United States dollars per troy ounce, the broader narrative of this metal, its role, its tension, and its place in the modern world, reveals deeper structural forces at work. Silver is not a name most casual observers ponder when they read market news. Few ask what an ounce of silver really signifies beyond price movements, yet that very indifference, the assumption that markets are shaped by random fluctuations, hides the true story of a market experiencing one of the most profound transformations in decades. This is not speculation. This is not a fleeting trend. This is a reflection of forces that have been building over years, quietly reshaping demand and supply, industrial demand and strategic significance, global competition, and economic evolution. A simple price. With complex roots on January 9, 2026, silver is trading near $78 per troy ounce, modestly stronger than recent sessions, and showing gains of nearly 10% since the beginning of the year. Some might look at this minutes to minutes swing and call it noise. Others might see it as profit-taking following last year's record-breaking run. But those narratives miss what has truly anchored this year's price behavior, and they expose a broader misunderstanding of what drives the silver market. Just months ago, in 2025, silver delivered its strongest performance in decades. From the early months of that year into December, prices surged to levels not seen in more than 40 years, propelled by a rare combination of industrial demand, structural supply deficits, and shifting macroeconomic forces. Such a rally could not be reduced to simple momentum or speculative enthusiasm. Beneath the striking numbers lies a story of long-term market realignment, one that stretches across sectors and continents. To understand the significance of January 9, 2026, we must first explore how silver's role shifted from the margins of the commodity markets to a central player in global industrial demand and structural imbalance. The historical view from marginal metal to mainstream force. Silver's history is one of dual identity. For centuries, it has been valued both as a monetary metal, a store of value alongside gold, and as an industrial input essential for manufacturing. That dual identity was once balanced, with neither side exerting overwhelming dominance. But over the past decade, a confluence of events dramatically changed that balance. The first chapter of this modern transformation began slowly. Unlike gold, silver is rarely mined on its own. Most silver is a byproduct of mining for other metals such as copper, lead, or zinc. As a result, even when prices rise, the economics of base metal mining dictate that silver supply cannot be rapidly scaled. Miners prioritize their main product, and silver remains a secondary output. This structural feature of the market quietly constrained new supply growth, even as demand began to evolve. Meanwhile, industrial demand slowly accelerated. Photovoltaic cell manufacturing for solar panels began absorbing an ever larger share of annual silver supply. By the mid-2020s, solar consumption alone accounted for more than 20% of total silver demand, a figure that was expected to rise further as the global transition to renewable energy gained momentum. At the same time, other vectors of demand emerged. Electric vehicles, with their complex wiring and sensor systems, increased industrial consumption of silver. High-technology industries, including semiconductor manufacturing and data infrastructure, relied on silver's unparalleled electrical conductivity in components where alternatives simply could not match its performance. This industrial rise was matched by enduring roles as a monetary and strategic metal. In the United States, silver was formally recognized as a critical mineral, opening new policy considerations around supply security and national economic resilience. So by the early 2020s, silver stood at a crossroads. The metal was no longer merely a speculative or store of value asset. It had become a strategic industrial material, essential to the technologies underpinning the 21st century's energy, transportation, and digital revolutions. Yet supply growth had not kept pace. Mine output remained constrained by geological and economic realities. Recycling provided some additional metal, but nowhere near enough to close the gap between what the world consumed and what could be produced. By 2025, as global energy transitions accelerated and industrial uses surged, this structural imbalance fully emerged as a defining feature of the silver market. The great surge of 2025, not just a rally, but a shift. Silver's performance in 2025 was nothing short of extraordinary. From a decade-long trading range below significant supply pressure, the metal rallied, not in fits and starts, but in a sustained wave driven by deeper demand than the market had ever seen. Many traders remember the spectacular moves in gold that year, but silver outperformed even gold. While gold enjoyed its best annual performance since 1979, rising more than 60%, silver's gains were historic in their scale and persistence. By the end of that year, the silver price had climbed into record territory, shattering decades-old ceilings and challenging long-held assumptions about the metal's role in global markets. Why did this happen? A confluence of forces converged. Industrial demand escalation. Solar installations reached new heights of adoption as nations accelerated renewable capacity growth. Electric vehicle markets expanded across Asia, Europe, and North America. And advanced electronics, from AI data centers to next-generation telecommunication systems, drove demand for high-performance conductive materials in which silver remains unmatched. Structural supply deficits. For multiple consecutive years leading up to and including 2025, global silver demand exceeded total primary and secondary supply. This persistent deficit quietly eroded stockpiles around the world, draining inventories that had once served as buffers against price shocks. Geopolitical tensions and strategic accumulation. Global trade tensions, export controls, and shifts in policy around critical minerals added layers of strategic competition to the silver market. Countries focused not just on prices, but on securing physical metal for future industrial and economic resilience. Macroeconomic backdrop, central bank policies, expectations of interest rate reductions, and periods of currency adjustment all played into broader precious metals demand. Silver, because of its hybrid industrial and store of value nature, reacted to these macro influences differently than gold, sometimes amplifying moves rather than merely following them. The result was a market that no longer resembled the silver markets of the past. What had once been a niche or secondary trading asset became a focal point of industrial necessity and global strategic planning. And yet, as silver approached these new heights, the price behavior also began to reveal another layer of complexity, one rooted not just in fundamentals, but in how markets interpret structure, liquidity, and sentiment, the mechanics of volatility, how markets read structure. By the close of 2025, after an unprecedented run, silver prices had become highly sensitive to both physical supply signals and financial market dynamics. One aspect that often escapes casual observers is the difference between the physical silver market and the paper market, where futures contracts, index funds, and exchange-traded instruments play out price movements that may not always align with real inventory conditions. In early January of this year, as precious metals entered the annual index rebalancing window, markets experienced mechanical selling pressure. Futures positions tied to major commodity indices like the S&P GSCI and Bloomberg Commodity Index began realigning after last year's outsized performance. This triggered price-insensitive flows that momentarily pushed prices lower, even as fundamental demand remained strong. To many analysts, these technical flows are noise. But in a market where underlying supply is tight and industrial demand is persistent, such mechanical pressures do more than move prices for a day or two. They reveal how fragile equilibrium has become, how structural forces can manifest as heightened volatility as market infrastructure adjusts to new normal conditions. Banks such as HSBC have noted that while the broader outlook for silver remains bullish, the near term may be marked by volatility and uneven price action, particularly in the second half of the year as structural and technical factors intersect. At the same time, commentators from global financial institutions like Goldman Sachs have highlighted how shifts in inventory locations, such as metal sitting idle in U.S. vaults while benchmark pricing is set in Western futures centers, can create regional imbalances that amplify price swings. What this means is not chaos, but a market reaching new levels of complexity as it transitions from traditional supply-driven cycles to a regime where industrial demand, strategic accumulation, technical mechanics, and geopolitical undercurrents all interact. Geographic dynamics. East and West in silver markets. Another dimension of silver's evolution lies in how different regions approach the metal. In Asia, particularly in China, markets have shown sustained participation in physical silver acquisition rather than merely trading paper contracts. As industrial growth targets continued to expand, Chinese trading platforms and physical markets became arenas where metal was absorbed rather than circulated. By contrast, Western markets have maintained a stronger emphasis on futures, ETFs, and financial products. While these instruments serve important roles in liquidity and price discovery, they can sometimes obscure the underlying physical deficit that persists outside financial transmission mechanisms. India, another major hub, has experienced similar cycles of sharp price swings on local exchanges, reflecting both global influences and domestic demand conditions. On January 9 alone, markets in New Delhi reported significant daily price movements, shifting prices by millions of rupees per kilogram in response to global waves of profit booking and shorter-term positioning. This geographic tension between physical accumulation and paper market influence adds a layer of narrative often overlooked by most routine reporting. Silver, in the industrial era, more than any time in its long history, silver's structural story in 2025 and 2026 is an industrial story. Solar energy, electric vehicles, advanced electronics, data centers, communications infrastructure all rely on silver not as a luxury or decorative metal, but as an indispensable material. Its unmatched conductive properties make it critical in sectors where reliability and performance are non-negotiable. Global industrial demand patterns show that silver is now absorbed by sectors that are themselves defining the 21st century. Solar installations continue to scale globally, with silver as a core component in photovoltaic cells. Electric vehicle production, even as it faces its own cycles of growth and slowdown, still demands significant quantities of silver wiring and connectors. And advanced electronics, from AI servers to next-generation networking gear, rely on silver where alternatives fall short. The very notion of silver as a commodity is evolving. It is no longer simply a raw input. It has become a strategic material embedded in technological transitions that underpin global energy transformation, digitization, and emerging infrastructure. Macroeconomic and policy backdrop. The broader economic backdrop of 2025 and early 2026 also shaped silver's path. Monetary policy in major economies, particularly in the United States, lowered real yields through a combination of interest rate decisions and inflation expectations. These conditions traditionally support precious metals by reducing the opportunity cost of holding non-yielding assets. At the same time, geopolitical tensions, from trade disputes to regional conflicts, underscored questions about supply chain resilience for critical materials. Silver, once relegated to niche discussion, found itself in the same strategic dialogues as other essential commodities like copper and rare earths, where supply concentration and geopolitical access matter. Institutional players also joined the narrative. While silver has historically attracted less central bank attention than gold, investment vehicles and sovereign holdings began to reflect changing attitudes toward the metal's dual properties. In some regions, this manifested as increased ETF flows. In others, it showed up as reserves accumulation and strategic stockpiling. January 9, 2026, a pivotal day. So what, if anything, does January 9 mean? To the casual market observer, a modest uptick in price might appear as nothing more than a routine rebound or a technical bounce, but when placed within the broader context of a market grappling with structural deficits, heightened industrial demand, regional accumulation patterns, rebalancing mechanics, and strategic geopolitical narratives, this day becomes more than routine. January 9 represents the confluence of forces that do not simply push prices from point A to point B, but rather reflect a market in transition, a market where price movements are evidence of deeper shifts in how silver is consumed, stored, valued, and integrated into the global economic fabric. This is not a rally built on hype. It is not a crash driven by fear. Instead, it is a portrait of a resource whose path is shaped by enduring structural realities and evolving global demands. Today is January 9, 2026. For most people, it is another quiet step into the new year, a day defined by routine and habit rather than consequence. Markets open, charts update, and headlines recycle familiar language. Yet within the silver market, This date sits at a delicate intersection of pressure and transition, where price movement is no longer driven by excitement, but by structure. What appears ordinary on the surface reflects a system adjusting to forces that have been building steadily for years. In recent sessions, silver has continued to trade near the upper range established during the historic surge of the previous year. After spending much of 2025 breaking through levels that constrained it for decades, the metal entered the new year not in retreat, but in consolidation. This distinction is subtle, yet crucial. Consolidation after a multi-year breakout does not signal weakness. It signals absorption. It suggests that the market is redistributing ownership rather than reversing direction. Much of the public discussion surrounding silver at the start of 2026 has focused on short-term explanations, profit taking, index rebalancing, seasonal adjustments. These narratives are not entirely incorrect, but they are incomplete. They describe mechanics, not causes. They explain how price moves, not why the market has reached a state where small adjustments generate outsized attention. To understand why January 9 matters, one must step back from daily charts and examine the longer arc of silver's evolution. For more than 40 years, silver existed in a strange limbo. It was recognized as valuable, yet rarely trusted. It was traded, yet seldom respected. Each attempt to rise beyond historical ceilings was met with skepticism, rooted in memory rather than reality. The shadow of earlier collapses lingered long after the conditions that caused them had changed. What finally broke that cycle was not speculation, but necessity. Over the past decade, silver's industrial role expanded quietly and relentlessly. Technologies that define the modern economy increasingly relied on its properties. Solar energy systems demanded it for efficiency and durability. Electric vehicles required it for reliability and safety. Advanced electronics and data infrastructure depended on it for precision and performance. These were not optional uses, they were structural. At the same time, silver supply failed to respond in proportion. Unlike many commodities, silver is rarely mined for its own sake. It emerges primarily as a byproduct of other mining operations. This reality limits how quickly production can increase, even when prices rise dramatically. New projects take years to develop. Existing mines optimize for their primary metals. Silver output remains constrained by design. This imbalance between growing demand and rigid supply did not appear overnight. It accumulated gradually, year after year, often overlooked because price remained subdued. But by the early 20s, the gap became impossible to ignore. Global consumption began exceeding production consistently. Stockpiles that once cushioned the market thinned. Leasing rates signaled tightening availability. Physical metal moved from open circulation into long-term storage. By the time silver entered 2025, the conditions for a structural revaluation were already in place. What followed was not a speculative frenzy, but a repricing of reality. As price advanced, it did not encounter the usual flood of new supply. Instead, it encountered restraint. Holders became less willing to sell. Institutions reassessed risk. Industrial buyers secured long-term contracts. The market's elasticity diminished. This change in behavior marked a turning point. In previous cycles, rising prices attracted sellers eager to exit. In this cycle, rising prices attracted confirmation. Each new level held reinforced the perception that silver was no longer a marginal asset, but a contested one. The events surrounding January 9 reflect this shift. Price fluctuations at this stage do not represent fear or enthusiasm. They represent negotiation. Negotiation between those who control physical supply and those who require it. Negotiation between financial instruments and industrial reality. Negotiation between old assumptions and new constraints. Geography adds another layer to this dynamic. In Asia, particularly in China, the emphasis has remained firmly on physical accumulation. Industrial growth strategies prioritize material security. Silver is treated not merely as a tradable commodity, but as a component of long-term planning. In contrast, Western markets continue to rely heavily on paper instruments and derivatives for exposure. This divergence creates friction between pricing mechanisms and physical availability. As silver flows eastward into industrial and strategic use, the pool of freely circulating metal contracts. This does not immediately translate into price spikes, but it alters the market's sensitivity. When supply becomes concentrated, small shifts in demand produce larger reactions. Volatility increases not because the market is unstable, but because it is tight. Technology continues to accelerate this process. Artificial intelligence infrastructure, once a niche sector, has become a cornerstone of economic competition. Data centers multiply, energy density rises, reliability becomes paramount. Silver's role in these systems expands accordingly. Unlike consumer electronics, where substitutions may exist, high-performance environments demand materials that meet exacting standards. Silver remains unmatched in this regard. Energy transition policies further reinforce demand. Despite efficiency improvements that reduce silver usage per unit in some applications, overall deployment volumes continue to grow. The math remains clear: fewer grams per unit multiplied by vastly more units still equals greater total consumption. This dynamic is unlikely to reverse in the near term. Meanwhile, recycling has reached practical limits. Much of the easily recoverable silver has already been reclaimed. Remaining sources are dispersed, embedded, or economically marginal. Recovery costs rise. Yield declines. Recycling no longer provides the buffer it once did. Mining faces similar constraints. Regulatory scrutiny, environmental considerations, and social expectations lengthen development timelines. Even when prices signal opportunity, response is slow. The supply side of the silver market remains fundamentally inelastic. Against this backdrop, macroeconomic forces add complexity rather than clarity. Interest rate expectations, currency movements, and policy debates influence sentiment, but they do not alter the underlying imbalance. Silver's price may respond to these signals in the short term, but its trajectory is anchored by physical realities. This is why surface explanations feel increasingly inadequate. When commentators attribute movements solely to monetary policy or speculative positioning, they overlook the deeper drivers. Silver is not reacting to a single variable. It is responding to a convergence of demands that do not retreat easily. January 9 stands as a moment where this convergence becomes visible, not dramatic, not explosive, but unmistakable to those who understand the structure. The market is no longer asking whether silver matters. It is negotiating how scarce it is willing to become. Psychology plays a crucial role in this negotiation. For decades, investors were conditioned to distrust silver. Volatility reinforced caution. That conditioning does not disappear instantly. It fades as evidence accumulates. Each year of sustained demand, each quarter of persistent deficit, each technological cycle that embeds silver deeper into essential systems. By early 2026, that evidence had become difficult to dismiss. Institutional behavior began reflecting a shift from tactical exposure to strategic consideration. Holding silver was no longer viewed solely as a trade. It was increasingly seen as a hedge against structural strain. This change does not guarantee linear price appreciation. Markets rarely reward understanding with simplicity. Instead, they test conviction through periods of uncertainty. Consolidation, retracement, and volatility are not signs of failure. They are features of transition. The silver market today resembles other resource markets at similar inflection points in history, when oil became central to industrial economies, when copper became indispensable to electrification. In each case, prices adjusted, not because of speculation, but because demand reshaped value. Silver is undergoing a comparable transformation. Its story is no longer confined to precious metals desks. It intersects with energy policy, industrial planning, and geopolitical strategy. It reflects a world grappling with material limits amid technological ambition. This broader context reframes the significance of ordinary days. January 9 does not need to announce itself with drama. Its importance lies in what it confirms: that the forces reshaping silver did not dissipate with the turn of the calendar, that the market did not revert to old patterns, that consolidation occurred above levels once considered unreachable. Understanding this allows observers to detach from noise, to recognize that markets do not always communicate through headlines. Often they speak through persistence, through the quiet refusal of prices to return to former ranges, through the steady absorption of supply. The lesson embedded in this moment is not about predicting what comes next. It is about recognizing what has already changed. Silver is no longer defined by its past volatility. It is defined by its present necessity. As 2026 unfolds, the silver market will continue to challenge outdated narratives. Some will interpret volatility as risk. Others will see it as adjustment. The difference between those interpretations lies in whether one understands structure. Structure is slow, it is patient, it does not announce itself loudly, but once established, it exerts influence relentlessly. January 9 is part of that influence. A quiet confirmation that the silver market has entered a new phase, one where value is shaped less by memory and more by reality. And in markets, as in history, reality eventually asserts itself. The lesson beyond today, the story of silver in 2026, is not about guessing the price tomorrow. It is about recognizing the forces that shape the metal's role in the world. It is about understanding that markets reflect more than charts. They reflect collective decisions about technology, energy, security, utility, and value. If silver's journey over these past years has taught anything, it is that markets rarely reveal their true direction through short cycles alone. Instead, they reveal patterns, pressures, and demands that unfold over years, even decades. January 9, 2026 is not merely a snapshot. It is a frame in a larger narrative, one that connects centuries of human ingenuity, industrial evolution, economic strategy, and global competition. And as we observe these developments with calm, informed perspective, we begin to see not a market moving randomly, but a world increasingly shaped by deeper structural imperatives.